I'll make some very brief remarks, and then I'll ask my senior colleagues whether they want to say something, and then we can get on to the Q&A. In terms of the performance of the economy last year, I think it would be fair to say that the focus that has been placed upon stabilizing the economy was beginning to bear fruit. If you look at inflation and the external account as the two key indicators of a stability of an economy, you would see that inflation had two spikes during the course of last year. One during the first quarter of the year, then again in the last quarter of the year. And the spike in the last quarter of the year was almost entirely due to weather-induced supply disruption. And there was a period when the headline inflation went outside our target 4 to 6% range. But core inflation, by and large, remained within the target range. And as of now, as of March, headline inflation has come down to 3.2%. And core inflation is even lower. So inflation has been contained, and the fairly tight monetary policy stance that has been taken since the beginning of 2016. Some measures were taken even earlier, but from 2016 onward, one could say there was a tightening bias in monetary policy, and that has served to stabilize inflation. And some of the underlying indicators like credit growth, like M2B, the broad money growth, etc., have now come down to levels that the central bank finds acceptable. So that's in terms of the internal stability of the economy. Broadly, we are where we want to be in terms of inflation, in terms of monetary aggregates, in terms of private credit growth. If you look at the external account, again, there was disruption caused by the weather, which meant that the current account deficit ended up at 2.6% of GDP, which was somewhat higher than we originally anticipated. And if you look, that was almost entirely due to increases in oil expenditure on oil imports, which was a result of the much heavier usage of thermal generation because of the disruption to hydro because of the drought, and also due to rice imports because of the impact of 3 consecutive cultivation seasons being affected by the drought again. So it was really weather-induced. And there was one other factor, which was the increase in gold imports. But now the Ministry of Finance has taken certain measures which have taken away the opportunity to arbitrage the tariff differential between India and Sri Lanka, which was resulting in what we think were fairly large amounts of smuggling, which actually had a negative impact on the balance of payments, with gold imports rising sharply to $650 million US dollars last year. So those were the reasons why the current account slipped. 2 of the main reasons were again beyond our control, as they were weather-induced. But we expect the current account again deficit to come down to about 2.1% this year. So the broad message in terms of stabilization of the economy is that the monetary policy stance adopted by the Monetary Board has brought about the outcomes which they would have hoped for. So we are in a reasonable place in terms of stabilizing the economy. I should also say that the central bank, since on exchange rate policy, over the last 18 months, has followed a flexible, market-oriented exchange rate policy. It has not intervened in terms of selling dollars into the market since February, March of last year. Despite that, the exchange rate during the course of last year depreciated by only 2%. And at the same time, the central bank on a net basis was able to purchase 1.6 billion US dollars, which was a major factor in increasing non-debt creating reserves. I should also mention really on the external front, not only, the current account deficit did deteriorate somewhat due to factors beyond our control, but the overall balance of payments was in surplus by $2 billion US, largely because of various financial flows. The international sovereign bond, a term loan, the first couple of tranches of the Hambantota long lease, and there was, as I said, the central bank purchasing 1.6 billion, record inflows into the stock market, and also about 400 million that flowed into the government securities market on a net basis last year. So all this meant that the reserves, which were $6 billion US at the end of 2016, increased to 8 billion at the end of 2017. Not only did the volume increase, but the quality improved as well, because the short-term swaps with commercial banks was reduced from 2.5 billion US dollars to 1.5 billion USD. So an improvement in both the quantity and quality of reserves. And since then, of course, we have seen reserves increase to almost 10 billion. It's as of today, I think it's 9.991 billion US dollars, which is a record level of reserves for Sri Lanka. But this is nothing, we shouldn't be, banging too many drums, because quite a lot of it is due to borrowed build-up of reserves, including the sovereign bond that we issued of 2.5 billion a couple of weeks ago. But nevertheless, we have seen an improvement in the quality of reserves, as I said, in addition to the quantity. Reserves at 10 billion, which is a record. We are reducing short-term swaps, as I said, reduced by $1 billion last year. We are going to reduce it by a further 800 million of this year. So you're going to see a build-up in reserves, at the same time an improvement in the quality of reserves. And the central bank is continuing to buy reserves this year as well. We bought on a net basis about 450 million. So all in all, on the stabilization fronts, inflation is under control. The underlying factors, indicators on the monetary side are where we want to be in terms of the broad money aggregates, the private sector credit. The inflation expectations seem to be pretty well anchored. We don't see any major wage pressure. On the external side, the current account should adjust back down to about 2.1% of GDP. Last year we had record exports, record FDI, and that this year there's a reasonably good beginning as well on those fronts. So taken all in all, that's on this. Economy is stabilizing, and in terms of the government strategy of improving exports and FDI from a very low base, an extremely low and very disappointing base, we are making progress in the right direction. Where the outcomes, I should say, are not as positive as we would like it to be, was in terms of the growth in the economy. It came out at 3.1%. We think the potential growth rate is about 5.75. So clearly there is a big output gap, which is one of the reasons why the central bank, the monetary board, signaled that it had ended the tightening phase of its monetary policy a few weeks ago by reducing the upper bound of the policy rate corridor by 25 basis points. So that is where we need to see improvement. We need investment, local and domestic, to pick up. We need good quality growth, but this growth needs to be driven by continued reforms, not by an undue relaxation of policies, fiscal and monetary policies which result in an overheating of the economy. Time and again, we've been through that cycle of trying to go for growth by inappropriate macroeconomic policies, overly relaxed macroeconomic policies, which in the end ends up with overheating. Final thing I should have said is that on the fiscal side, it's broadly on track. The overall budget deficit of 5.5% was larger than the target, primarily due to relief that had to be given because of the drought and floods. Despite that, a couple of significant structural improvements have been achieved on the fiscal side, which is one, a primary surplus in the budget for only the second time since 1955, I think. And this year, they're expecting a surplus in the current account for the first time since 1987. So the VAT reforms have kicked in, and some improvement in tax administration. The introduction of the Inland Revenue Act in April is likely to bring in further improvements, and the balance of probability is that the government's revenue enhancement based fiscal consolidation program will progress as anticipated, but that is crucial. I'm sure there will be political pressure to try to perhaps undermine the framework, but it's very important that this fiscal consolidation continues. And the progress that the government has made was reflected in the recent staff level agreement with the IMF on the 4th review of the extended fund facility. There is one other measure that has to be taken, which is the introduction of the automatic fuel pricing formula.